What is up, and welcome back to How to Invest in Commercial Real Estate.
Happy freaking New Year.
Yeah. It's been a minute.
Got some snow today.
We did. 6 inches of nice, beautiful, fluffy snow.
Oh, yeah. It's nice.
I saw some dude snowboarding down the downtown streets of like Kansas City or something. It was actually kind of nuts.
Yeah, it's funny.
Yeah, hopefully you guys already got your cold plunges in, because I did.
Yeah, I did.
No, liar.
No, I didn't. I can't get my...
Oh, you can't get that wet.
Yeah, I can't get it wet.
Well, he only gets down to here anyways.
That's right.
So your arm's not going to get wet.
Anyway, the big news, guys, it's distribution time again. And it's bigger than ever. More distributions going out to investors than we've ever done on any quarter since we started this gig.
Yeah.
What's the number, Braden? Do you know approximately what we're sending out?
No.
Good.
He doesn't know.
Did you do your research before the show?
I did, but obviously all of these financials aren't ready yet, so we don't know exactly. But
next week we'll have it.
Hundreds of thousands of dollars.
Yeah.
And then we had several sales recently, and so all of the money's going back to the investors plus the returns. And so I think we're going to be shipping back on some level $5 million in this quarter.
Yeah. If you include Q4 distributions with all the return of capital from the sale and the profit, easily $5 million, maybe more. Nice. We've got a ton going on right now. There's a ton of deals in the pipeline. We've got 3 or 4 shopping centers under contract, or we're negotiating the PSA on them. So, yeah, we're optimistic that we can hopefully get a lot of that money back and place it back into the market in a great cash flowing shopping center.
So, okay, Braden, Brian, question for you guys. How is that translating into overall market conditions? Obviously, you say you've got a ton in the pipeline. Why is that? What are we doing?
I mean, I'd say prices have finally reset, right? For a long time, we didn't buy anything. Interest rates went up. We had to borrow at higher rates, and the cap rates weren't going up.
Yeah. And then kind of started to climb out of that last year.
Right.
End of last year, Q3, Q4, like Q3 for sure, you had to be a seller, in my opinion. You had to put a realistic price out because it just got so saturated. Nothing was transacting for like a year. So the market kind of gets backlogged with all of this inventory, and then prices have to go down because buyers can be way more picky and choosy on what they're buying. You know, there may be 150 Starbucks on the market. There may be 100 learning experiences or early childhood education centers on the market, and you know, so on and so forth.
I think that just continued. We had a lot of activity in 2024, right? Because prices finally started to come down. I think sellers right now realize, okay, interest rates aren't falling as much as everybody thought. We can't raise our price.
Yeah.
We got to continue to sell at reasonable cap rates, and I think that's good for us. I mean, we did it in 2024. I don't know why we can't do it in 2025.
Yeah, I mean, I think we all thought that interest rates are going to be working their way down
faster. I thought it was going to be faster.
Faster. And, we had a 1 or 2 rate cuts, but the economy stayed resilient, and there's still some inflationary pressure out there. And so if I had to redo my forecast for 2025, I don't think rates are going to be coming down that much in the next year, maybe 2. I don't know. It just depends. As long as the market stays hot, they're going to stay higher. But that's okay for us because we're seeing sellers willing to sell at higher cap rates. Before, it used to be really hard to get a 9 cap on a retail shopping center. And now we're seeing 9, 9.5, 9.75 all over the place. That's why we have 2 or 3 that we're negotiating right now. And so, you could say, well, okay, you're buying 9, 9.5 cap, but you have to put the debt at 7. That's fine, guys, because we're still hitting our cash on cash return numbers. We're still hitting our IRR projections. And I don't mind for the next 10 years if we load up on deals at 9, 9.5 cap and at 7.5% interest rate, because we only need an event, a market crash, hopefully not a COVID type event, but where interest rates come down, we can refinance all of it.
Yeah, well, we don't really need it. We'd like to see it happen, right? We don't need it because the
numbers are hitting the numbers
right now. But if it did happen,
that we're going to be way in the money. And I would say 90% of our portfolio we can pay off and refinance anytime. No prepay. And so that's going to be awesome. Whenever those interest rates come down, the more assets we accumulate at higher cap rates due to higher interest rates, the better it is for us when the rates come down.
Yeah, and it's a bit more of a different strategy where interest rates are lower and you're buying more of a stabilized asset. It's really just a stabilized positive leverage play. You know what I mean? You don't have to do anything else. It kind of works day one as it is. Whereas now, you have to do a bit more work to get the cash flow you like. But in retail shopping centers where we're looking, you've got a significant lack of supply because of those same high interest rates, right? Like, and cost of construction is insanely high since COVID. Hasn't really come down a lot. So the developers aren't building. So we've got a ton of new businesses, like retail's thriving. We've got all of these retail stores that are continuing to open.
Yeah, they're not building new buildings. They got to move into open space, right?
Yeah, and for example,
I
I think Lowe's is opening 150 new stores this year, which is huge, and they're going into smaller markets, and that's going to create a ton of retail demand next to them. It's going to create out parcel demand. So the retailers are doing really well, but the developers can't really afford to develop the buildings right now. So you're seeing in a second or third generation retail deal, you may have tenants that are at $9, $10, $11 a foot or lower, right? Mm-hmm. We've seen a lot lower, and the market is completely full. Right? There's nowhere else for them to go. Nobody's really building any new product. And the market rent for a new tenant is $16 or $17 a foot. So when you're looking at that from a renewal standpoint, you can underwrite a lot more aggressive rent growth, right?
Well, yeah, you say 15 or 16. I mean,
could be higher.
That's
higher.
For like big box stuff. If it's brand new, inline, 1,500 square foot retail, I don't know how you deliver it for less than $35, $40 a foot.
Yeah.
And we, like I said, we're buying stuff that's half of that. Mm-hmm. I mean, I'll take our Florissant deal outside of St. Louis where we have the American Freight. American Freight had an issue. Well, that's fine. It's a big box space for us, but we're at $4 a foot in rent. Yeah. And so
I think it's less.
If anybody's in the market for a big box space, they're not going to have a vacant big box space that they can get for less than $4 a foot. So we can backfill that tenant if we need to.
Yeah, so the rent growth, right? You're going in, it may be a little skinny year one, but these leases are going to roll over, and over the first several years, you're going to be able to significantly increase your cash flow, which we've seen in a lot of centers we bought over the past several years, that cash flows continue to increase as we get these renewals. County Line is a great example of one here in Broken Arrow, right? The cash flow this year is going to be the best it's ever been, almost double last year, because the renewals have been so successful because of that exact same thesis. There's nowhere else for these tenants to go. Market rent is substantially higher, and they got into these leases 10, 20 years ago when it was a lot more competitive for the retailer. There was spaces for them to go. They could go deliver new products. So it's kind of brewed up the perfect storm for a ton of opportunity, in my opinion.
I think it's less risky, guys, going forward. If it's just less risky to be getting into deals that cash flow and that work at higher interest rates, because you have the opportunity for them to go down and you have less opportunity for them to drastically go up. Where we were getting loans in the 4% range, 4.5% range, that was awesome, making great spread, but you have a built-in inherent risk to the interest rates rising and that negatively affecting the value that you purchased it at. So we're really, really optimistic about 2025 and the opportunities that we're seeing, getting into deals at high cap rates with higher interest rates, reducing that risk, and then trying to drive rents up. So
yeah, that and overall, I think the market is picking up. We're starting to see a lot of things transact. I know we mentioned we had several sales right before the end of the year. All of our Petromax deals sold. The Perfect Auto deal in Vegas, that deal sold.
Mm-hmm. But let's mention that just real quick because that was a deal that did not go quite as good as we wanted it to go. And I just think that's a good talking point real quick before we end the show. Thought we were going to put it right on the market and sell for a lower cap. That didn't happen. We had to adjust our cap rate up, given interest rates, given the flood of all the retail deals on the market last year. And so we ended up having to take a price that was lower than expectations. But even in a situation where we had to exit a property at a price we didn't want to exit, we still managed to get double-digit returns for the investors. And so when you have deals that don't work and you're still getting above 10% returns, didn't lose anybody's money, but also gave them a return. I think that's a win.
Not too bad.
And that's, go ahead.
Yeah, and I think a lot of sponsors let their pride get in the way and force themselves to sell at that underwritten cap rate. Instead of us, during the year, we were constantly adjusting that price down to what we thought was the market rate, to where we thought it would transact. And a market rate is what a seller is willing to sell for and what a buyer is willing to pay, right? So we knew that needed to transact. And I think a lot of sponsors, a lot of investors can get blinders on with price when there's two levers, and it's price and time. So we knew that we were equally fighting time, and the market isn't getting super less saturated. Like, there's still a ton in the market. So we knew that it was better to sell now as opposed to waiting potentially years to maybe get a slightly better price.
Yeah, and take that money and put it somewhere else, because we don't have a lack of deal flow. So
Exactly. Yeah, that's a great point. I'm going to hit a little harder on that point. Is you've got the IRR that you're trying to hit. That's a time-driven metric.
Yep.
And so let's say these deals are, that Perfect Auto, for example, it might have been cash flowing 8%, but we were trying to get a high IRR by selling it at a higher price. Didn't get it. So then we had to make the decision. Okay, do we exit the deal and give them miss the returns? And the answer is yes, because if I can get you 100% of your capital back plus 10, 11% return on that capital, and I can deliver you another property immediately where you can get it invested at, a 10 or 12% cash on cash with the potential of hitting a 20, 22% IRR, right, in the same year. So we're not hanging on to your money. We're giving it back to you, but we're saying, hey, let's double down on that and get it invested in another deal and get that earning 20% instead of the 8% we were owning that Perfect Auto indefinitely, waiting on a purchase price that we may not have gotten.
Right.
So anyway, I think it's a huge win when sponsors can recognize that, get the money back to the investors, and then let them choose which additional investment they want to get into.
Yeah, overall, I think it's not doom and gloom. Now is a great time to be buying real estate. We're very optimistic. I would say we're very busy. The investor appetite is there. Sellers are selling. Buyers are buying. It's not extremely difficult to get a loan right now. I would say we haven't ran into any significant challenges. If anything, it's getting easier than the past 6-8 months because the volatility freaks everyone out, including lenders. Like, people want to know what next month, next quarter, next year, the next 5 years is going to look like. It's very important. So the longer of this stable period of time we've been going through, the better. Everyone's going to feel more natural, like it's a normal course of doing business. So I think it's a great time to do business. We're excited.
Yep. All right. If you have questions about commercial real estate, you want to get involved in investing, hit us up and send us a message, and we'll connect with you.
Sweet.
Thanks. All right. Till next time.